swap market making kind of thing that's going on is happening at all maturities. Okay. The first example I gave was 5 years, okay, but there's also 30-year swap markets. There's also 1-year money market swaps. So this is where all the liquidity is. All the liquidity typically is in derivatives markets because you're not using much capital. In fact, you're not using any there's no actual loans happening here. These are swaps of IOUs. The whole thing is swaps of IOUs, all the way down. You make money, hopefully later on, because you're selling one IOU for a higher price than you're buying the other IOU. And that's basically the business. This is banking. This is banking, but without the actual loans. You know, the loans are just now kind of vanished, okay? But the cash flows are all netted, okay? But this is what you need to have in mind as the core of the system. The core of the modern system works like this. It's not Jimmy Stewart banking, you know, where you have a deposit account that's invested in a mortgage, okay? This is what is happening in the world, where you have swap dealers that are quoting two-sided spreads, making markets, and therefore making prices. Okay, so I quote from an amusing passage from Stigam, page 900. She says, money market swaps, this sort of thing, occur in what could rightly be called arbitrage land. Traders arbitrage swaps against futures, swaps against cash, swaps against frauds, frauds against futures, and so on. Arbitrage opportunities keep arising because these related markets are constantly affected by many different events. Maybe an Asian bank does a big cash and swap arbitrage, which drives up the swap market. This creates profit in the swap-FRA arbitrage. So someone does the swap-FRA arbitrage, which drives up frauds. This creates profit in the FRA futures arbitrage. So someone does the FRA futures arbitrage, which drives up futures. An event that moves one rate causes a rate ripple that creates some basis points for every play, except maybe the futures player, if he's an unhedged speculative trader. Clearly someone loses, usually the spec player in the futures pit. Okay, she's writing here. A lot of interesting things there. Okay, you see there's a sense of hierarchy that's going on. This one leads to this one, and where does it end up? It ends up in the futures market. Okay, where people are hedging price risk, okay, and what they're taking on is liquidity risk in the futures market. Okay, and that's where that's where the chain stops. Okay, right there. That's why we did last time this thing on forwards and futures. That's where the chain stops. There's another thing, you know, this idea about arbitrage land. Okay, this is exactly the same idea in this 1952 piece from the FOMC. Okay, they're talking about government securities. They're talking about security dealers doing term structure arbitrage. They're buying the 5-year when it looks cheap, but using it as collateral to finance in the repo market, some primitive repo market. Okay, and then they're selling the 10-year, and so they're doing a term structure arbitrage from the 5 to the 10-year, and so on and so forth. Well, that they saw, 1952, is the future. Okay, except it's not just government securities markets, it's corporate securities markets. These are basically corporate bonds. This is what Stigam's talking about. And it's not just corporate securities markets, it's mortgage markets. Residential mortgage-backed securities were the next step of this, okay? Which is, what is a residential mortgage-backed security? It's a 30-year bond. Okay, and with various weird option structures because of the ability to repay early and things like that. But so this apparatus, this interest rate swap apparatus, okay, that was developed to create liquid markets in corporate securities, okay, natural thing in the world, the most natural thing in the world. Just say, well, why don't we take all of that and move that over into mortgage space, okay, and just use that there, you know. And that's exactly what was done. It's exactly what was done, and led to a global market in these household securities, household bonds. Okay, AA LBO, subprime, right? Subprime mortgages. So this is the way this world works.